Good afternoon, it's Jeffrey Christian. It's about 2:35 on Tuesday afternoon, the 22nd of November here in New York. I wanted to talk today about bad data and specifically a common misrepresentation that we hear far too often in commentary about gold and silver and money and currencies and such, related to a person I have great respect for, Thomas Jefferson. Before I do that, I will say that I remember another year in which the 22nd of November fell on a Tuesday, and that was 1963, and that was the day that JFK was shot in Dallas, Texas. I also point out that, we won't have a video on Friday. We're taking a long 4-day weekend for the Thanksgiving holiday. And a little bit with the spirit of Thanksgiving, I wanted to focus on something that Thomas Jefferson said, and something that he never said, but is often misrepresented as having said. Now, in bringing that up, that brings up other egregious misrepresentations in the markets. And, people have been on me to talk more about what is wrong with some of the analysis that you see on gold and silver and platinum, where you have deficits and where they throw in investment demand surrogate numbers with fabrication demand so that they can say, oh, this market's in shortage and shortfall and there are deficits and the price has got to rise. Other people are asking us to talk about what's wrong with doing that and what's the right methodology. We don't mind talking about the right methodology, but we try to focus on real market conditions in these discussions and in our research and our analysis and our publications and our consultations. We try not to talk about what other people are doing that may be less than accurate or inappropriate approach to commodities research. And we like to focus on, like I said, our research and the real markets, but there are a lot of people who are asking us to do that. But let's just run through a few. Back in August, a fellow named John commented in one of our videos saying, I will give it till November, and then the jig's up for the US dollar and the bankster crooks that run this show. I assume that he meant that everything would collapse, the dollar would collapse, the banking system would collapse, all of the bankster crooks would be rounded up and put into concentration camps or whatever. It led to the CPM challenge. We simply said, look, if you're one of those people who for a year or 10 years or 40 years have been telling investors that the prices of gold and silver have to rise to unrealistic prices, that the world's running out of silver, running out of copper, running out of gold, that the financial system's going to collapse, that governments are going to confiscate everybody's money, and it just never happens, we challenge you. Do what John did. Set a date. John's going to be here. It's November 22nd. There are, 9 days left in November. And John's going to live up to the challenge, and he's going to say, okay, I've been wrong all along. Maybe he'll go back to college, maybe take some night courses in Money and Banking 101, read some good books on it, get away from all of the garbage that he reads on the internet about this and that and the other thing. If you're a promoter, leave the business. If you're an investor, stop wasting your financial life and your wealth by investing based on these bad things. Now, silver market's not in a deficit, to address some of those questions that we have gotten repeatedly over the last several trading days. These are CPM groups estimates of supply and demand, surpluses and deficits, net additions and net withdrawals to global inventories, reported and unreported, since 1960. You can see large periods of net additions or surpluses, during which investors were bidding up silver away from fabrication demand and pushing the price higher. Surpluses in the silver market and in the gold market actually correspond with rising and strong prices. and deficits with lower prices. So you see periods of time of surpluses where investors are bidding up the price of silver. And you see periods of deficits, 1990 to 2005, when investors are actually selling silver on a net basis collectively and helping to depress the price, keeping it between $350 and $550 for 15 years. The market right now is not in a deficit. Commodities Research 101, you measure a market balance as total supply less fabrication demand. Marketing groups add investment demand to the fabrication demand so they can say, hey, this market's in a deficit, the price has to rise. But that's not the way the markets work, and that's not the way good commodities research and analysis works. Another thing you keep hearing is that, the price of silver is so low that mining companies simply can't mine silver. Now, 75-80% of the silver that is mined in the world annually comes from copper, lead, zinc, and gold mines, and it's a byproduct. So that silver is going to be mined almost regardless of what the silver price is. The other 20 to 25% comes from primary silver mines, mines where silver is the primary product. And a lot of those mines have byproduct copper, lead, zinc, and gold, which reduces the operating cost. These are cash operating costs, but if you look at all-in sustaining costs too, you will find that there's a very large profit margin in being a silver miner today. You can see on the right-hand chart that, the price of silver, this is through 2021, because it's from our 2022 silver yearbook. The price of silver was around $25 on an average basis, and the average cost for primary silver mining companies, cash cost, was less than $10. And even when you add in all those all-in sustaining costs, you find that the cost of producing silver at primary mines was far less than $25, and there was a very good profit margin. And then you say, okay, and then 80% of the mine production comes as a byproduct. So this isn't an issue. The left-hand chart shows you the primary silver producers' cash cost curves in 2020 and in 2021. And you can see, again, that about 90% of the producers had cash operating costs below $15 an ounce. So silver market is not facing a situation where you need massively higher silver prices in order to justify building and operating silver mines. Now, on to Jefferson. And I want to thank Monticello.org. This is a repository of all things Jefferson. It's, I guess, related to the Monticello and to the estate or whatever it is that has what Jefferson said. Now, there's a quote you hear over and over again from Thomas Jefferson. He never actually wrote it or said it, but you hear it all over the place. And here, I'll read it for you. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all their property until their children wake up homeless on the continent of their fathers conquered. I believe the banking institutions are more dangerous to our liberties than our standing armies. The issuing power should be taken from the banks and restored to the people to whom it properly belongs. Boy, those are damning words. Unfortunately, Thomas Jefferson never said 3/4 of them. We're going to go through what he said, what he actually wrote, and what he didn't write. And what he wrote is very important. What he actually wrote was in a letter to John Taylor in 1816, I sincerely believe with you that banking establishments are more dangerous than standing armies, and that the principle of spending money to be paid by austerity under the name of funding is but swindling futurity on a large scale. So there's that one part of all of this stuff that he's claimed, that people claim he said, that one part in there. I believe that banking institutions are more dangerous to our liberties than standing armies, is what he actually wrote. The rest grew up around him by people who wanted to use his reputation to deceive people. He also wrote in a separate place, bank paper must be suppressed, and the circulating medium must be restored to the nation to whom it belongs. Okay, let's take a look at that. The issuing power, bank paper, should be taken from the banks and restored to the people. Oh, no. He's saying it should be restored to the nation. Big difference. We'll get back to that one. The first part of the inaccurate quotation, the people ever blah, 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 it's just not there. It's not true. He never wrote it anywhere. Inflation and deflation, the Monticello organization says, point out that inflation and deflation did not enter the English lexicon of words until after Thomas Jefferson had passed away. So I guess he could have written it because he was a kind of a prescient guy. But no, he didn't. He never wrote that. And he didn't write it to Gallatin. The quotation is often said that it was in an 1802 letter to Albert Gallatin, who was the Secretary of the Treasury under Jefferson, and later published in this publication, The Debate over the Recharter of the Bank Bill. The first known occurrence of this was actually in 1948, when a congressman, talking about some legislation, said that, and then quoted Jefferson as saying, I believe that banks are more dangerous than standing armies. And then it all got glommed together by somebody who's, oh yeah, well, Jefferson said the whole darn thing. But he did it. In addition to that, there's no such thing as the debate over a recharter of a bank bill publication that the Monticello organization or the Library of Congress have been able to find. So it's just not there. Pipe dreams. The third part of the quotation, the issuing power should be taken from the banks and restored to the people to whom it properly belongs. That was in a letter or a comment to John Wales Epps in 1813. Now, very important, the word changes. Bank paper must be suppressed, and the circulating medium must be restored to the nation to whom it belongs. With bank paper, he was talking about private banks issuing currencies, because that was the situation when the first Bank of the United States wasn't in existence and operation, and when the second Bank of the United States was not in operation after he had passed away, and before we had a centralized, nationalized bank. You had private banks issuing bank paper, which were used as circulating currencies, and was prone to being overprinted in that those private banks, lacking a firm national overseer, regulator, auditor, knew that they didn't have to have gold and silver and other banks' currencies in their deposits. They could just keep printing up private paper as long as could be. And Jefferson was saying, no, those private banks are the problem, and that's not good. And the circulating medium were the script that they printed on their own and was used as circulating currencies. So it's very important to understand what he was referring to as a bad thing. And it's also very important to say that he was saying the control of circulating currency needed to be restored to the nation to whom it belongs, not to the people who live in that nation. Thomas Jefferson had a pretty good idea of what was needed for stable money. It just wasn't what these guys on the internet want you to believe. That's all we have. It's a little bit aside from the precious metals markets, but as those of you who watch these things know, I really don't like people who misrepresent other people, and I don't like people who misrepresent reality, and who either consciously or unconsciously pass out falsehoods. You can read about us at our website, cpmgroup.com. Get some free reads. You can order our yearbooks. You can buy other types of research and consulting services. We're not going to be around on Friday. We're going to be taking the time off. I won't be shopping. I'll probably be hiking someplace because that's what I do instead of shopping. And we'll see you next week. Take care of yourself. Take care of the whole